So thank you for subscribing to the socialcharity.org website. This explains Section 664 of the tax code, and that section was passed by Congress actually now over 50 years ago. The American taxpayers need to become familiar with this section so they can use it for themselves, their families, and their communities. It's a very important part of the planning for our country moving forward. This presentation is for educational purposes only. It is not a political presentation, nor is it an advertisement to sell products. The presentation is sponsored by the Advisors in Philanthropy Foundation, which is a nonprofit 501c3 organization, in conjunction with its Council of Professional Philanthropic Advisors. You're probably familiar with these sections of the U.S. Internal Revenue Code and how they can benefit you. Section 529 helps you send your kids to college. Section 401k helps you to fund your retirement. Now, you know those names or those numbers by virtue of having seen them or listened to them being described elsewhere, and they become familiar to you. So we know that Section 529 has to do with college education. Most people who have kids know that, who have been to an investment advisor. They've been told about that. It's been suggested to them probably. And Section 401k is very similar. If you're working at an organization that has a Section 401k, you know that they're taking contributions from you to build your retirement under that section of the tax code. That's the important part, is that there's sections of the tax code. Now, there's another section of the U.S. Internal Revenue Code that you need to know about, and also how it will benefit you, and that's Section 664. This is the section that Congress passed back in 1969, and it's designed to help you, your family, and your community. You and your family can receive future income and tax savings, and you can do something important for your favorite charity. We've called this social SeCHARITY, and this is the way that we can change things in America. We can change the way our social services are provided. We need to have the paradigm shift that was suggested in the animation that you saw. The paradigm shift is moving from government providing social services to your favorite charities providing social services. The section of the tax code, Section 664, and social SeCHARITY, those terms need to become interchangeable in our lexicon, in our everyday language. That Section 664, just as Section 401k or Section 529, they're available to be used. You have to know what they do, and you have to know how to use them. That's the important part. The discussion about the paradigm shift is relative now because our debt, our public debt, has expanded tremendously, and it's been exacerbated in the last roughly 40 years to the point where we're at now, which is about $23 trillion in debt, or maybe even more than that at this point. This is caused by government providing social services in excess of what the government has actually been designed to do. And so each year there's a budget overrun or a deficit spending that creates more public debt. The debt has started to reach an unsustainable point, and it's on a path now that if it continues, it will be a significant financial problem to the country as a whole. As you can see in the graph, the debt held by the public as a percentage of GDP has been growing exponentially for quite a while. It's estimated that in 2048, if we don't do anything to change this, it'll be 152% of gross domestic product. Very well-known philanthropists, the visionary giving pledge philanthropist, that's Bill Gates, Warren Buffett, very wealthy individuals in this country who control a very large amount of the wealth. They have become the giving pledge philanthropists because they want to help change the situation, and they have recognized government has shown over the past decades that it can no longer solve the great problems of the day. Section 664, which was created 50 years ago in 1969, social SeCHARITY is the right solution at the right time to help create a paradigm shift while also providing benefits to you. So the government realized that it wasn't going to be easy to get individuals to make contributions to the charitable sector, and so they gave incentives for doing that. We all know that you get a tax deduction for making a gift to charity, but they went a little further, and they made provisions that if you were to leave something to charity at your death, you would get some benefits while you were alive, and that's what the section of the code actually does. Now, as a result of people in our country wanting to create more income, this section of the code is perfect at this time. We know that most Americans want to create more future income that they can rely on. The young in the country, those under 45, actually worry about Social Security, and rightfully so. They've been told and they've heard that Social Security is going to be out of existence in the not-too-distant future. Not only does it have the potential of going out of existence, but the cost before it gets there is going to start to accelerate, and the cost and the burden of supporting a large generation of retired individuals based on a smaller generation of working individuals is going to become very burdensome. So the question that most people under 45 ask is whether or not Social Security is actually going to be there. But Social Security is one of the things that many people do count as part of their retirement resources. There are other things that you can do for future income, but there are challenges. When you work in a firm that has a retirement plan, it may have a 401k plan, it may have a pension plan, a profit-sharing plan, or you individually may have your own IRA plan. The problem is that those are limited in contribution. You can only contribute so much of your income each year into whichever of the plans you have available. The other thing is that once money gets into these plans, you have to be disciplined. Young employees have accumulated money. Now they leave their job and they're between jobs, and the next thing that happens is they start to borrow against the 401k or their pension or profit-sharing accounts, and that really ends up creating a future deficit and makes it more difficult for retirement funds to be reached. They're also not mandatory. In other words, there's no requirement that any employer provide you with a retirement plan. They're all really subject to the benefits that the employer wishes to give or can afford to give to their employees. And the other thing is, even if they're mandatory that they be provided, the participation is not mandatory, and many people opt out of these plans because they don't understand them or they're not sure whether or not they can handle the contributions that are required. So Section 664 can help Americans create more future income that they can rely on, and that's one of the benefits that people need to become more aware of. Social SeCHARITY and Section 664. Social SeCHARITY and Section 664. They can help Americans create more future income that they can rely on. Most Americans want to pay less tax. Tax changes occur. They can go either way. Sometimes it's good, sometimes it's bad. The problem is that it's not in our control. But we do know that there are some ways to pay less tax that are already given to us, that have been given to us for a long time, and that we've been using as planning tools for those people who are in a position where they have significant taxable income. They use tax-deductible retirement plans that we just discussed. The IRA, the 401ks, the pension plans, profit-sharing plans. Those are all tax-deductible retirement plans. Depreciation is another way to pay less tax. However, depreciation is limited. If you own real estate, you know about depreciation and the fact that it can eliminate income tax for the early years of the property's ownership by creating a paper loss against income. You can have short-term and long-term capital losses. Not that they're great to use for tax avoidance, but if you have them, they will be used to offset long-term capital gains or short-term capital gains. And then you can make direct charitable gifts or a gift to a donor-advised fund, and those are tax-deductible charitable gifts, and they will help you pay less tax depending on the amount that you put into those funds. Section 664 in Social SeCHARITY can also help you pay less tax. The section was designed to help you reduce your taxes, create income, and thirdly, to do something for your favorite charity. We know that most Americans want to do something for their favorite charity, regardless of what style of the charity or what the ultimate beneficiaries of the charity are. Most people do want to do something for charity. And so Section 664, Social SeCHARITY, helps you do that in a very easy and reasonable way. Most people are familiar with bequests. There are traditional ways that people have left gifts behind. Bequests are done in wills. However, the difference between a bequest and using Social SeCHARITY in Section 664 is that there's no future income, and you don't get a tax deduction while you're alive if you leave something in your will. You can also make a donation directly to a donor-advised fund or to charity outright during your lifetime. Again, when you do that, there is no future income. So these are traditional ways to do something for your favorite charity, but there's also another way, and that is using Social SeCHARITY and Section 664. They can help Americans do something for their favorite charity while also doing the other things that we discussed. Create more future income that you can rely on, pay less tax, and ultimately do something for your favorite charities. Here's a simple illustration of how a charitable trust, which is a Social Security gift, would work. In this instance, a donor makes a gift to a charitable trust that the donor creates, and the charitable trust has an agreement with the donor to receive the gift and in exchange for that gift to return income and a tax deduction during the life of the individual. When the donor puts the money into the charitable trust or the asset into the charitable trust provides a tax deduction and then also a promise of future income that will continue for a term of years or for the life of the individual. At the end of the life of the individual or the end of the payment period of the income, the asset that's in the charitable trust then goes to charity. It can be used in this form to create endowment as opposed to current income needs. Social SeCHARITY uses these planning tools. Charitable remainder trusts, these are fairly complex planning tools. They're really good at any age depending on how they're designed. They are called split interest trusts as well, a little bit complex in the planning and drafting stage. And so the consultation with an advisor who is versed in these charitable remainder trusts and in the complexities of how they're used is an important part of this process. The pooled income fund is not quite as complex as a charitable remainder trust. It basically allows an individual to put money into a charitable pooled income fund in exchange for the promise of income immediately or at some point in the future, or small amounts in the beginning, bigger amounts later on. This is also a split interest trust, and it's important that you consult an advisor for the proper use of a pooled income fund. The third type of charitable tool that's used in Social SeCHARITY is a charitable gift annuity. These are fairly simple. They're generally designed for the older charitable giver, the 55 and up donor. In this case, you should check with your favorite charity because not all charities have charitable gift annuities available. Charitable gift annuities are based on the ability of the charity to guarantee the income to the individual. The charitable remainder trust and the pooled income fund are separate trusts and are separate and apart from any charitable entity, though they require a charitable entity to create them. But they're not part of the charitable entity's assets. That's the difference between that and charitable gift annuity. Same thing's true with the charitable remainder trust. What's really important about Social SeCHARITY in Section 664 is that you can use non-cash assets to do planning with them. And these generally represent 95% of the net worth of most Americans. The non-cash assets are your commercial and personal real estate, private business interests, tangible personal property, equities, bonds. And it's important to note that when you're using a private business interest, for example, any of these things, the same thing is true with all of them, you need to have a proper appraisal done by, for tax purposes, by a bona fide appraiser, whether it's real estate or a private business interest or even tangible personal property. Equities and bonds are fairly straightforward because you can see what the values are by looking in the Wall Street Journal. But commercial and personal real estate, private business interests, and tangible personal property are a little more complex, and so they require a bona fide tax appraisal in order to be able to use them in Social SeCHARITY devices. But your financial facts and circumstances drive the planning that's done, and it's different for each of us. Therefore, you really need to know how Social SeCHARITY or Section 664 will benefit you. The best way to use Social SeCHARITY in your planning is to consult with your personal advisors and or a professional philanthropic advisor. There is an expert in the design, implementation, and management and the use of these Social SeCHARITY devices, whether it's a pooled income fund or a charitable remainder trust or a charitable gift annuity, or even the more exotic charitable lead trusts. These are all planning tools that have been around for a very long time and have really been used by the ultra elite in the country pretty much because they were able to work with advisors that could deal with these complex devices. But now that there's a professional philanthropic advisor category of professional, you have an advantage that wasn't available before. So a chartered advisor in philanthropy, which is a CAP, not to be confused with a CPA, is a professional with a postgraduate degree who provides financial counsel and financial services, and this includes the Social SeCHARITY planning. The CAP designation is granted by the American College of Financial Services, one of the oldest and most reputable institutions of higher learning for financial services. It is important to note that we consider all CAPs to be professional philanthropic advisors, and some work for the public and some work for charities. The social charity concept, the Section 664 of the Code, was not created for a limited number of people. It was created for the public's use. And so now, with a public professional philanthropic advisor to work with, Americans at all income levels can create future income that they can rely on, they can pay less tax, and they can do something for their favorite charity. And all of the planning can be done in the boardroom or at the kitchen table. In order to find a professional philanthropic advisor in your area, you search the Council of Professional Philanthropic Advisors. You can do this by becoming a contributor to this ENDOW America Network site. When you become a contributor, you will have access to not only the Council of Professional Philanthropic Advisors, but you'll also get to see what kind of work can be done using social charity devices, seen through case studies that we will be providing from time to time. And also, you'll have access to a full library of podcasts that have been created for the purposes of educating you about using social charity, Section 664 of the Tax Code, and working with a professional philanthropic advisor. Thank you for your attention to this, and we invite you now to become a contributor to get access to the rest of our program.